Okay, let's unpack this. Today we're taking an exploration, a deep dive really, into an investment classic. Philip A. Fisher's Common Stocks and Uncommon Profits.
Hmm.
What I found really fascinating looking into this was that Warren Buffett himself said he's an eager reader of Fisher, highly recommends him. And get this, it was the very first investment book ever to hit the New York Times bestseller list. Quite something, huh?
Yeah, indeed. Quite the pedigree. And our mission for this deep dive, really, is to pull out that timeless wisdom from this foundational work, to understand how these principles, well, how they're still vital for investors like you today, maybe even more so now.
Right. So what does this core idea, this philosophy, actually mean for, building wealth, beyond just chasing the latest headlines?
Well, Fisher's big insight, his revelation, was that the really spectacular fortunes, they didn't come from constant trading, not from trying to buy low and sell high all the time.
Right.
It came from finding those few exceptional companies, the ones with what he called uncommon profits potential. And then this is key, staying with them through all the market ups and downs.
Staying with them. So it's about picking the winners and having patience, distinguishing the really outstanding ones.
Exactly. And that brings up the big question. How do you actually spot these companies? Fisher's core framework is his famous 15 points. It's basically a checklist, a rigorous prescription for what to look for when buying.
15 points. Okay, what are some key ones?
Well, for instance, he really hammered home finding companies with immense potential, not just, next year's growth, but potential for sustained expansion.
Yeah.
New products, new markets, a really long runway ahead.
Makes sense.
And maybe the most critical point, management of unquestionable integrity.
Integrity. That sounds important, but maybe a bit fuzzy.
Well, he meant it wasn't just about basic honesty. It was about a deep sense of responsibility. To shareholders, yes, but also employees. He saw that as, foundational for long-term success.
Okay, that clarity on management integrity, that leads right into his famous research method, doesn't it? The scuttlebutt method. It sounds powerful, but maybe a bit, old-fashioned, talking to people directly. How practical is that for our listeners today in this digital age?
That's a really good point. And it actually shows how adaptable his ideas are. The spirit is definitely the same.
Yeah.
Go beyond the official story. But scuttlebutt today, well, it might involve digging through online reviews, or participating in specialized industry forums online, maybe analyzing patent filings to see what they're really working on, how strong their innovation pipeline is.
So it's evolved. It's about piecing together the real picture from various sources, not just the annual report.
Precisely. It's that kind of diligent, direct investigation that helps you steer clear of those hyped-up stocks, the scandal stocks, think Enron or WorldCom. Their fundamental weaknesses, the questionable practices, they'd likely become pretty obvious with that kind of real digging.
Right, you get past the Wall Street noise and understand the actual business on Main Street, so to speak, even if Main Street is partly online now.
Exactly. And connecting this to the bigger picture, Fisher argued these principles are actually even more powerful today. He saw this fundamental shift happening in corporations, management moving away from rigid top-down control
Autocracy, yeah.
towards more continuous self-analysis. This constant internal questioning, this drive to improve, it meant companies got way more focused on their own growth drivers. And that led directly to a much bigger emphasis on strategic R&D, research and development.
Okay, so innovation becomes central.
Absolutely central. Companies have to innovate constantly now. And those that manage R&D wisely, they secure just vast opportunities for future growth.
That makes a lot of sense. So beyond how companies run themselves internally, what else did Fisher see changing that affects us long-term investors? Anything surprising?
Oh, definitely. Beyond company specifics, he had this really profound grasp of the bigger economic currents. He noticed how major shifts in government policy, particularly after 1932, leaving the gold standard, the New Deal spending, how that introduced a subtle but persistent inflationary biases into the whole economy.
An inflationary bias. Okay.
Okay.
So what did that mean for investing?
Well, it led him to a conclusion that was totally against the grain at the time and honestly still challenges people today. He argued that bonds for the long-term individual investor were actually becoming undesirable.
Really? Bonds, the safe asset.
Yeah, because that steady inflation, even if low, just erodes their purchasing power over time. He saw high-quality stocks, equities, and great companies as a far, far superior way to hold wealth long-term. It was pretty revolutionary thinking back then, and, it still holds a lot of weight.
Wow. That's a powerful point. Definitely pushes against the standard balanced portfolio advice sometimes. So ultimately, Fisher's big lesson seems to be resist the crowd, find great companies, and crucially, embrace patience. Understand that knowing what will likely happen with great business is often clearer than predicting exactly when it will happen.
Perfectly put. And Fisher himself, he sort of believed his writings were like a mirror, helping people see the insights that were already kind of within them. He had that famous dedication in his book, right, to investors who, quote, do not adhere to the philosophy. I have already made up my mind. Don't confuse me with facts.
Yeah, a great line. It's a powerful reminder, isn't it? To always keep an open mind, always be willing to learn. So as you, our listener, reflect on Fisher's, let's say, unconventional wisdom, what preconceived notion about investing might you challenge yourself to re-examine today?